There are a range of situations in which a single business entity does not facilitate preferred commercial or taxation outcomes. For example, when unrelated parties go into business together, to protect assets of a trading business from creditors, or to present a corporate front to business stakeholders. In an ideal situation, the most appropriate business structure and combination of entities would be set up in advance of the business starting operations. However, as businesses evolve over time, this isn't always possible, and changes to the business structure may be required at a later stage. But care must be taken to consider any taxation implications for changing the structure, particularly CGT events relating to the transfer of CGT assets, as well as the potential application of relevant anti-avoidance provisions. Company structures protect owners from the debts of the company by limiting their liability to the share capital. They facilitate funding through new equity investment, and they have a lower tax rate than the top marginal individual rates. Company structures are also required for certain incentives, such as the employee share schemes and the R&D tax incentive. However, they cannot access the CGT discount, and losses can only be recouped if certain tests are met. Discretionary trust structures can limit the liability for corporate trustees, but do not appeal to new equity contributions. They are extremely flexible with income distributions and have access to the CGT discount and small business 50% reduction. But losses are trapped within the trust and can only be recouped if certain tests are met. Unit trust structures can limit the liability for corporate trustees and facilitate funding via new unit holder contributions. They can access the CGT discount and small business 50% reduction, although distributions of non-assessable amounts can trigger CGT event E4. Further, losses are trapped within the trust and can only be recouped if certain tests are met. Partnership structures have joint and several liability for partners. They can facilitate funding through new partners, but there may be tax implications on the dissolution of the old partnership. Partners can access the CGT discount, and losses are available to individual partners subject to the non-commercial loss rules. Here, a holding company owns a trading company. Any profits of the trading company are distributed to the holding company and therefore protected from creditors. However, any subsequent sale of the shares in the trading company would not avail the CGT discount. Here, an asset holding company develops and holds intellectual property and takes advantage of the R&D tax incentive, leasing the IP to a related operating entity. This protects the IP from creditors of the operating entity. Both entities are ultimately owned by a discretionary trust, maximising the flexibility of distributions and availability of CGT discounts. Here, two unrelated parties operate discretionary trusts with corporate trustees and form a general law partnership, which in turn forms a company to operate the underlying business. This structure presents a corporate front to business stakeholders and facilitates asset protection through having corporate trustees. It also allows for income splitting via the discretionary trusts, access to the CGT concessions, and any partnership loss can potentially offset other assessable income of the discretionary trusts. To recap, a single entity structure may pose some restrictions or limitations on desired commercial or taxation outcomes. However, a range of multi-entity business combinations can be structured to partially or fully offset those limitations.